Okay, class, here we are, and we're going to take a look at the Accounting 201 Fall 2018 midterm, and I'm going to go over um, the questions and the answers. Okay, so the first question I have here is, it's a multiple choice question, and it says the field of accounting that focuses on providing information for external decision makers is, okay, so when I go down here, well, managerial selection A is not the correct selection because managerial accounting is for internal users, people and decision makers that are inside the company. As we know, financial accounting is for external users, people that are going to be using the company's information to make investment or lending decisions, taxing authorities that look at that information as well. Cost accounting is more along the lines of managerial accounting. So cost accounting is focused on internal users, and non-monetary accounting is probably just a little bit of noise in there, so that doesn't make any sense in this question. So I'm going to go with B. And we'll go next. Okay. Now, this question 2 in my midterm, the assets of Star Company are 120,000 and total liabilities are 10,000. Okay, so we'll pull our little Excel up here so I can diagram how we get to the answer for you. Let me make it a little bit. Okay, so they want to know what equity is. The question asks what equity is. So down here, if you remember the accounting equation, assets equal liabilities plus stockholders equity, okay, which we could say equity for short. So they're telling me that the total assets are 120,000. Okay, and if I just build that into my equation, and total liabilities are 10,000, okay, and we don't know what equity is, we're kind of solving for equity. So if you do simple algebra, you end up with 120 minus, if I move that 10,000 to the right side of the equation, right, I get 120,000 minus 10,000 will give me my equity. Okay, and if you flip that around, you'll have equity equals 110,000. Okay, so you could basically go and find 110,000 in your multiple choice selections, and that would be item D here. Okay, moving on to the next question. Question 3 of 20. Saturn paid 13,000 on accounts payable. How does this transaction affect the accounting equation of Saturn? Okay, so what I would do first is I would probably diagram that. So if Saturn paid 13,000 on accounts payable, you know that we are going to decrease accounts payable with a debit. Okay, so you know that you're going to have a $13,000 debit. That's a decrease to accounts payable, and you're going to have a credit to cash, because whenever you pay money out, you're decreasing cash. Cash is an asset, accounts payable is a liability. Okay, so it's important you know your debit and credit rules. Okay, so let's see. So basically, it looks like liabilities are decreasing and assets are decreasing. Okay, so let's see what our selections are. First one, assets decreased by 13,000. That would be correct, but it's not equity that's increasing or decreasing. So equity is irrelevant. Let's see, assets decreased by 13,000 and liabilities decreased by 13,000. I like that one, but the way I solve these multiple choice questions is I look at all the options and make sure there's nothing else that's better. Okay, so assets increase. I'm going to rule that out right away. And equity is irrelevant. Okay. Assets increase. We rule that out. Liabilities did not increase. So C and D are wrong when we look at those. So it looks like it's B. Assets decreased by 13,000 and liabilities decreased by 13,000. And we'll go next. Okay. Now it says business. A business performs services for a customer for 26,000 on account. Which of the following accounts is debited? Okay, so again, it might be helpful for you to diagram your whole journal entry, just so you're sure, right? Remember, if something is done on account, that means all of a sudden, if we perform services on account, we have what we call an accounts receivable, and that's increasing with a debit, and then you're going to have some sort of revenue. Okay, service revenue, sales revenue. Okay, so it's going to be 26,000 debit to accounts receivable and 26,000 credit to a revenue account. So let's see. It's not cash. We know it's accounts receivable. Service revenue is actually getting credited, so you can rule that one out. And accounts payable is irrelevant. There's nothing relating to accounts payable. So I'm going to click on B here. Accounts receivable gets debited. Okay, here's question 5. Let's see what we do on this one. Okay, so the following transactions for the month of March have been journalized and posted to the proper accounts. Okay. Sometimes in a longer one like this, it helps for you to come down to the bottom and see what they want to know in the end. So I'm looking at this last phrase, and they're going to want to know what the balance in accounts receivable is at the end of all of these transactions. So what I'll do is I'm going to set myself up a T account. You probably would draw this out by hand and give yourself a T account, but since I have the Excel open here, I'm going to go ahead and do that. Make myself a T account, and we'll label that. That'll be a labeled accounts receivable. Okay, and then I'm going to use this to look at each of these transactions, okay, and see what their effect, what each transaction's effect is on accounts receivable. Okay, so it says for a month of March, on March 1, the business received 8,000 cash and issued common stock to stockholders. Okay, so that doesn't have an effect on accounts receivable, so I'm going to ignore that. We paid the first month's rent, no effect on accounts receivable. Purchased equipment by paying 2,000 cash and executing a note payable for 6,000. No effect on accounts receivable. Purchase office supplies for 750 cash. No effect on accounts receivable. Billed a client 14,000 of design services completed. Okay, so if you bill a client, that increases accounts receivable by 14,000. And then on March 6th, we received 5,000 on account for the services previously recorded. So that's going to reduce accounts receivable because you're actually getting paid. So if you were to take a balance in that account, it would end up being $9,000 because 14,000 minus 5,000 is 9,000. So you can look here, 5,000 no, here's your 9,000. Okay. Question 6. Which of the following is a financial statement that presents the business's accounting equation? Okay, so remember, income statement is your revenue minus expenses. Okay, statement of retained earnings is really your beginning retained earnings plus your net income minus dividends. And that'll give you your ending retained earnings. Okay, balance sheet shows assets equal liabilities plus equity. Okay. So those are the three financial statements that we have focused on to this point. And obviously the balance sheet is the one that's showing the basic accounting equation. Assets equal liabilities plus equity. So I'm going to go with balance sheet. Next, let's see, question 7 of 20. And I'll scoot that up there so we can see the question, and then I can show you how the work is done in this Excel sheet. And keep in mind, I'm just using Excel to scribble my notes for you. You could do it by hand if you had to. So it says, during the accounting period, office supplies were purchased on account for $3,200. A physical count on the last day of the accounting period shows $1,100 of office supplies on hand. Supplies expense for the accounting period is $3,300. What was the beginning balance in office supplies? So again, we're in a situation where the T account becomes very handy because we can diagram what happened. Okay, so we're gonna label this account office supplies. Okay, and in this situation, they're actually giving us the ending balance. Okay, they're saying that our ending balance should be 1,100 because that's the amount of office supplies that are actually on hand at the end of the accounting period. Okay, they tell me that we purchased during the accounting period, we purchased 3,200. So that's an increase to office supplies. Then it says supplies expense for the accounting period was 3,300. Now that's a decrease to office supplies because remember, I'll just do a side entry here, right? We'll debit supplies expense and credit office supplies as the supplies are used. Okay. So we know that this 3,300 here I'll label it fully. This 3,300 here in yellow is that corresponding credit from that journal entry that had to have happened for supplies expense to have been recorded. So office supplies would have decreased for the effect of supplies expense. So really what we're doing now is we're solving for the beginning balance. Right? What we need to do is figure out, that's the question mark, we need to figure out what the beginning balance was. So we're saying, what plus 3,200 minus 3,300 gives me 1,100. So I'll use my question mark as the variable, okay, instead of x or n, right? So what plus 3,200, right, minus 3,300 equals 1,100. Okay, so a little bit of algebra if you do it this way, and then you could move like terms. So you really could put everything, all the numbers on one side of the equation. You could technically net these two out. So 3,200 minus 3,300 is a negative 100. Okay, so it really becomes what minus 100 equals 1,100. Okay, and then if you move it to the other side, right, whatever you're looking for, your beginning balance will be 1,200. Okay, because when that negative 100 moves over, it becomes positive. Okay, so your beginning balance should equal 1,200, and then what you do is you come back and you test it. You make sure it's true before you choose your answer. So I'm going to put 1,200 up here, and then I'm going to test it. So I'm going to say 1,200 plus 3,200, okay, and that will be 4,400. Okay, so 4,400 minus 3,300 equals 1,100. Okay, if you don't believe it, use your calculator or whatever, and that's what I'm doing here. I'm going, right, I'm just referencing and redoing the math. So 1,200 plus 3,200 minus 3,300 gives me 1,100. Okay, so our answer is sitting right here in green. Okay, 1,200. So you look down here and we'll say 1,200. Okay. Now, question 8. The entry to record depreciation includes a credit to. So you have to remember your journal entries for depreciation. Say depreciation was $500. Well, of course, you're going to have a debit to depreciation expense and a credit to specific type of account, contra asset account called accumulated depreciation. Okay, so we said maybe 500. Right. So it always helps to remember how the journal entries are done and how the credits and debits and credits affect each type of account. So we're going to look down here. There's no such thing in this case, no such thing as depreciation payable. Cash is irrelevant. Depreciation expense is where the debit would go. They're asking for the credit, so be very careful. Right? It'll be accumulated depreciation credit. Okay, now question 9 of 20. Unearned revenue is recorded when? Okay, so you have to think about unearned revenue. How is unearned revenue? When does unearned revenue get involved? Well, if you receive cash in advance of the goods or services that you're going to provide. So say someone or a company pays your company in advance, and you haven't delivered the goods or you haven't provided the services, then all of a sudden you have a liability called unearned revenue. So you know your unearned revenue would increase with a credit. So we'll do the credit first. Say it was for services worth $2,000. Okay. Now on the other side of that, you would have a debit to cash because cash was received in advance. As the work is performed, right? Say your company performed $500 worth of those services, you would reduce the unearned revenue. Oops, I left the word revenue out of here. And because you did perform $500 worth of the services, you would credit revenue. So in this situation, revenue is increasing and unearned revenue is decreasing. Okay, so two journal entries that involve the unearned revenue. When money is received before the services are performed or the goods are delivered, and the elimination of the liability, of the unearned revenue liability, when the services and goods are actually provided and are goods. Okay, so let's see what kind options they give us. Unearned revenue is recorded when revenue will be both collected and earned in the future. No, because it would involve a collection in advance. Okay, so if you're not going to collect it until the future, when you earn it, then nothing's recorded. The business has collected cash but not yet earned the revenue. That's the one that corresponds closely with this one in green that I have here. So that's probably one of the best options so far. C, revenue has been collected and earned during the same accounting period. No. Okay, that you just record revenue when that happens. You don't have to have any kind of unearned revenue. The business has earned revenue but not collected cash for the revenue. Okay, that's a situation where accounts receivable would be involved. Okay, you would record revenue and you would record an accounts receivable for D. So yes, it looks like it's item B. Move on to the next one. Okay, what is an account? Okay, an account that is not closed at the end of the accounting period is called. Okay, so remember, the accounts that are closed are called temporary. Okay, and they include revenue, any revenue account, expenses, they include dividends, they include an account called income summary that we use at the end of the accounting period. And if you wanted it, it probably would be more accurate to show it in this order. So close revenue, close expenses, close income summary, close dividends. Those are called temporary accounts. So the ones that are not closed, even if you did not read the chapter, you could kind of think, well, the opposite of temporary would be permanent. So permanent accounts are not closed at the end of the accounting period. And those would, permanent accounts would be, let me just list those. Permanent accounts would be assets, liabilities. In the equity section, common stock and retained earnings. Those accounts are not closed. They're called permanent. Okay, just so you know that. Okay, on to the next question. Which of the following are temporary accounts that are closed at the end of the year? Okay, so great. This kind of plays right into the previous question. If you had listed it down in your head, it might look like this. So you got temporary and permanent. So which are temporary accounts that are closed at the end of the year? Well, we know they're not assets, liabilities. Dividends are closed, but assets and liabilities makes this choice wrong because those are permanent accounts, assets and liabilities. Revenues, expenses, and dividends, those are over here in green. Those are temporary accounts. So that's probably going to be the answer, but what you want to do is you want to rule out the others. Okay, C can be ruled out right away because assets, liabilities, and equity are all on the balance sheet. All permanent accounts. You got to look at D, right? Be careful with D because those are revenues, expenses, but the fact that they put stockholders' equity in there makes that the wrong answer. So I'm going to go with B. Revenues, expenses, and dividends. Okay. Question 12 of 20. Brownstone Inc. has a current ratio of 6. This indicates that the company has $6 in. Okay, so in order to understand current ratio, you need to know the formula. Current ratio equals current assets divided by current liabilities. Okay, and they're saying that their current ratio is 6. So 6 will equal whatever the current assets are divided by the current liabilities, and it really is reducing down to 6. Okay, so let's see what this tells me. It says this indicates that the company has $6 in. Well, if you read these like a ratio, like a numerator and a denominator, then A would actually be the opposite of what the current ratio formula is. It actually has current liabilities on the top. Okay, so B actually makes sense. $6 in total. No, actually B doesn't make sense because it needs to be current assets. So you can rule B out because B is saying total assets. We only want current assets in the numerator. So C is looking a little better. C, $6 in current assets for every $1 in current liabilities. Okay, so you really have 6 equals $6 in current assets for every $1 in current liabilities. I like C the best. D we can rule out because they're talking about total assets. And they're also using current assets in the denominator when it should be current liabilities. So I'm going to go with C. Okay, next. Question 13 of 20. Let's see here. Now, we're probably going to need to do a little bit of math. Okay, it says a company has 110,000 in current assets, 600,000 in total assets, 80,000 in current liabilities, and 140,000 in total liabilities. Calculate the current ratio of the company. So we can incorporate what we just did. Current assets divided by current liabilities equal the current ratio. So for this problem, right, we'll just go current ratio will equal the current assets of 110,000 divided by the current liabilities of 80,000. Okay, and it's coming right from this sentence up here. And then all I have to do is take 110,000 and divide by 80,000. Okay, and in Excel you got to put an equal sign before that. I get 1.375, and it says round your answer to 2 decimal places. So it would be 1.38 because that 5 rounds up to an 8 for the second decimal place, right? Okay, 1.38. It says, okay, now 14 of 20. A company sold merchandise with a cost of $213 for $440 on account. The seller uses the perpetual inventory system. The entry to record the cost of merchandise sold would include. So it's probably important for us to look at the whole entry. You would have a debit to accounts receivable for what we sold it for, 440, and then we would have a credit to sales revenue, okay, of 440. And then remember, we, along with that piece of the transaction, the actual revenue side of it, we also have to record a debit to cost of goods sold for the cost of the merchandise and a credit to inventory, okay, sometimes called merchandise inventory. Okay, and we're in this part of the transaction, we're basically moving the cost of the items, which is 213, out of inventory. So you notice inventory is getting credited, inventory is an asset, and putting them into an expense, which is called cost of goods sold. Okay, so I'm going to look in there because that's what they're asking me for. And I can automatically rule anything with 440 out. So these two are not an option. Now C and D could be an option. Let's see. A debit to cost of goods sold and a credit to merchandise inventory. That's what we did in this gray area down here in Excel. Okay. And then just look at D to make sure it's not a debit. Well, it can't be a debit to merchandise inventory because that would be increasing the inventory account. And a credit to cost of goods sold would be decreasing the expense when we're actually trying to do the opposite. We're actually trying to increase the cost of goods sold with a debit and decrease inventory with a credit. So the answer is C. Okay. Now 15 of 20. Let me get our sheet ready. Which of the following inventory costing methods yields the highest cost of goods sold during a period of rising inventory costs? Okay, so remember the methods we had were first in, first out, last in, first out, and average cost, and the other one was specific identification. Okay. Remember that FIFO, first in, first out, will take the older items and put them into cost of goods sold first. So we would be working forward. And if we were in a situation with rising costs, then the older items would be cheaper, right? So we would end up getting cheaper items in cost of goods sold under first in, first out. Under last in, first out, the more recently purchased items are put into cost of goods sold first. So in times of rising costs, the more recent items that were purchased would be the more costly items. So by moving the more costly items into cost of goods sold first, you end up with a higher cost of goods sold using LIFO. Okay, last in, first out. So let's see, which of the following costing methods yields the highest cost of goods sold when there are rising inventory costs? And that would be like LIFO, last in, first out. Okay, item 16. Which of the following remains the same regardless of the inventory costing method used by a company? Assume the cost of inventory is rising. Okay. Well, of course, purchases are going to be the same because we're really using the same purchase amount, right? If we were to diagram a scenario using FIFO, LIFO, weighted average, specific identification, what we actually paid for the items wouldn't be different under each of those costing methods, okay? Assuming that we're working from the same scenario, okay? So that's probably going to be the best answer. Let's see. All of the others do change, right? Because cost of goods sold would be higher under LIFO, like we explained in the previous question, but that would make ending inventory lower than FIFO, okay? And of course, whatever goes into cost of goods sold affects net income. So if you're working with a higher cost of goods sold, you're going to have a lower net income, depending on your cost flow assumption. So I'm going to go with A. A is the most logical. Okay. Let's see what question 17 of 20 says. Which of the following items will not appear as deductions on a bank statement? So, which items are not showing as items that reduced your balance when you get your bank statement from your bank? Okay, so NSF checks, non-sufficient fund checks, those would show as a deduction. Electronic funds transfer, EFT, they would show as a deduction if they were transfers out. Service charges are also deductions because the bank charges your account and takes the money right out of your account for that service charge. Now deposits would not show as deductions. So remember, this is asking us which will not, because deposits would actually increase your account balance. So that's the one I'm going to choose. Okay. Here's question 18 of 20. Let's see. It says, a company received a bank statement with a balance of $6,400. So I'm going to call that my bank balance. Okay. Reconciling items included a bookkeeper error of $400, which says a $400 check recorded as $800, 2 outstanding checks totaling $830, a service charge of $24, a deposit in transit of $260, and interest revenue of $21. What is the adjusted balance? Okay, so if there's a bookkeeping error, that wouldn't affect the bank balance because it's saying that the bank is actually correct. So the bookkeeper inside our company actually made the error. So that would be done on the book balance piece of the reconciliation. So I'm going to ignore that one. Outstanding checks, of course, would be a reducing factor because outstanding checks have not cleared the bank yet. So those we're gonna reduce the bank balance. We're gonna use that amount to reduce the bank balance. So 830. I'll make it as a negative. 830 will be subtracted from the bank balance. A service charge actually is showing in the bank balance, so we don't have to do anything with the service charge because the bank already recorded that. Now it says deposit in transit. Deposit in transit is actually something that the bank has not recorded yet, so that would need to be added to the bank balance to make the bank balance correct. So 260 will need to be added, make it as a positive. Interest revenue, well, the bank is the one that's paying the interest to our account. So the bank has already recorded the interest revenue. We do not have to do anything with interest revenue. Okay, so with those items that are given, we can come up with the adjusted balance by first taking the bank statement balance of $6,400, adding the deposit in transit, and in this case it's really subtracting the outstanding checks, and I get 5,830. Let's see, and my selection here is D, 5,830. Okay. Now I'm on question 19 of 20, which is a conceptual question. Under GAAP, which of the following is not an acceptable method of estimating the amount of bad debt expense at the end of the accounting period? And let's look at our options. And from your reading, you should know that the direct write-off method is not acceptable. Okay, that's the one that is not an acceptable method of estimating the amount of bad debt expense. Really, there is no estimate done in that situation. It really, you just write the receivable off as something goes bad, so you're not really achieving the matching principle. Okay, and then let's see, question 20 of 20. It says, on October 1, 2018, Equipment Suppliers Inc. made a loan to one of its customers. Okay, so it's important that you kind of keep track of the dates here. So I'm going to go October 1, 2018. Okay, the customer signed a 4-month note for $110,000 at 12%. How much interest revenue did the company record for the year 2018? So you're looking at the time frame 10/1 to 12 to December 31st. So October 1st to December 31st, 2018. So it's okay if you use your fingers if you need to count out the number of months, but that's actually October, that's 1 month, all of November, that's 2 months, and all of December, that's 3 months. So you're looking at a 3-month time frame, okay, that we need to figure interest out for. Okay, so all we really have to do now is use our interest formula. So interest equals principal times rate times time in any order. Okay, so first of all, we're going to have our, and I'll just go interest will equal the principal, which was a $110,000 note, times the rate, which is 12% annually, times the time. Okay, so now we're looking at a 3-month, right? 3-month time frame that has passed. So I'm going to take 3 months, maybe I'll do this in parentheses, 3 months divided by 12 months in a year. Okay, and the reason I'm using 12 months is because that 12% rate is an annual rate, annual percentage rate. Okay, so we actually have to take a fraction of a year because only 3 months have gone by. Even though it's a 4-month note, they didn't say 12% per month or 12% per for a 4-month time frame. That really means that that's 12% per year. Okay, so if you do that math, you're going to end up with real quickly here, right? And you could go 3 over 12, or you know that it's 1/4 because 3 months out of 12 is 1/4 of a year, and we get 300 or 3,300, and your answer would be D. Okay. Submit for grading, right? And you would go ahead and submit for grading. All right. Okay, and that's your midterm review. Please let me know if you